If you are sitting on your condo's management committee, or if you are a condo owner, I have a sobering question for you. If your building caught fire tonight, would your insurance actually cover the cost to rebuild it? Most committees confidently answer yes. But the terrifying reality is that a staggering number of residential high-rise are severely underinsured. Today, we are talking about the hidden blind spots in condo master fire policies, the massive legal dangers facing management committees, and exactly how to fix before it's too late. Let's be honest, serving on an MC or JMB is a tough, often thankless job. You are trying to balance the budget, keep maintenance fee low, and manage day-to-day complaints. Because of that, when it comes to the building's fire insurance, many committees fall into three dangerous traps. Trap number one, the auto-renew habit. Year after year, the policy is simply renewed with the same provider, using the same old figures, without checking if the building costs have gone up. Trap number two, the lowest bidder bias. Choosing a policy solely because it's the cheapest premium, completely ignoring what is actually excluded in the fine print. Trap number three, guessing the building's value, relying on the original construction cost from 5 or 10 years ago, or worse, making an educated guess. So what happens if you get it wrong? If your building is insured for, say, 50 million ringgit, but the actual cost to rebuild it today is 100 million ringgit, you are 50% underinsured. Under insurance law average clause, if a fire causes 10 million worth of damage, the insurer won't pay 10 million ringgit. They will only pay half, 5 million ringgit. Where does the other 5 million come from? It comes out of the sinking fund or through a massive sudden special levy passed down to the residents. For condo owners, this means sudden financial ruin. But for the management committee, it's even worse. As a committee member, you have a fiduciary duty to protect the property. If it's proven that the building was negligently underinsured, committee members can be held personally liable for the shortfall. You could face lawsuits from the very residents who elected you. This brings us to the single most critical step that most committees overlook, a professional asset valuation. You cannot properly insure a building without a current certified valuation report. Building material costs, labor, and compliance law change constantly. A valuation gives us the exact reinstatement value, ensuring you are not paying too much for overinsurance, but more importantly, ensuring you aren't exposed to underinsurance. When you pair a fresh valuation with a comprehensive market review, you protect the entire community. And that is exactly where I come in. Managing condo coverage isn't a side hustle. It requires a specialized risk management expertise. As a financial advisor representative, I don't just hand your committee a single renewal form from one provider and ask for a signature. First, I walk your committee through the process of securing a proper, up-to-date valuation. Second, because I operate independently, I leverage my access across the industry to bring you multiple, highly competitive quotes from top-tier insurers. I do the heavy lifting, comparing the fine print, negotiating the best rates, and presenting you with a clear apple-to-apple comparison. You get to present the best possible coverage at the best possible price to your owners at the next AGM, showing true leadership and diligence. Don't leave your personal liability and your residence home to chance. Head over to keithwong.my right now or drop me a message. Let's do a quick, no-obligation review of your current policy and make sure your community is truly protected. Thanks for watching, and I look forward to working with your committee.